welcome to Lesson 6 of TradePhantoms Foundations of Trading. I'm Mr. Black, and in today's lesson, we're going to be talking about candlesticks, candlestick structures, balance candles, and then we're going to show you some bullish, bearish, and neutral formations of candles for you to start learning about. So this will be a short lesson, but let's get into a little bit of candlesticks and understanding their structure. To understand candles, you have to understand what they represent. What candles show you is price movement over time. Now you can have candles represent whatever time period you want. A candle could be a minute of trading, 5 minutes of trading, an hour of trading, a day of trading, a week of trading, etc., etc. You select the time period showing you on the chart, that's being shown on the chart. The candles are made up of two parts. You have the green and the red part, which are called the bodies of the candles. And then you have these little lines coming out the top and the bottom, which are called the wicks, or technically shadows, which represent the extremes of trading during the selected time period. If you have a green candle, that means that price went up during the selected period of time. If you have a red candle, that means that price went down during the selected period of time. So let's take an example here. Let's say each one of these candles is a daily candle. They represent 1 day of trading. If I'm looking at the candle on the left here, that means that on this day of trading, price opened at the very bottom of the body of that green candle. At some point during the day, price got as low as the bottom of that lower wick where it says low. At some point during the day, price got as high as the top of that top wick where it says high. But when the market closed for the day, price was at the top of the green body where it says close. So that's what you're seeing when you look at a candle. You're seeing the open, close, high, and low for the selected time period. Now, of course, as I said before, you can select whatever time period you want. You could be looking at minute candles, 5-minute candles, hour candles, so on and so forth. You choose the time period you're selecting, but that's what you're seeing when you look at the candle structure. Red candles are the same concept, except they open higher and close lower. So it went down during selected time period. So on a red candle, it's going to open at the top of the body of this red candle. At some point during the day, price got as high as the top of that wick where it says high. At some point during the day, price got as low as the bottom of the lowest wick at the bottom where it says low. But when the market closed for the day, price was at the bottom of the red body where it says close. So it's showing you open, close, high, and low for the selected time period. When looking at candlestick structures, there are really only 4 main formations that exist in the market. You can either have candles that have very small or no bodies, and these are going to represent equilibrium in the market, sometimes called indecision. What does that really mean? Well, think about it from this perspective. If I have equilibrium between buying and selling, you're not going to see a lot of price action in the market, and price is going to basically consolidate and move to the side, forming small bodied or no body candles where you don't have a big difference between open and closing price. What if I have a candle that has no wicks, that is all body? Well, that's going to be more indicative of directional movement. If I have a candle where the body opened and price just rallied the entire day up and then closed at the very top, or I have a price where it opened and just dropped the entire day down and then closed at the bottom, that's going to be more indicative of an imbalance in order flow, causing price to move up or down. So if I have equal numbers of buyers and sellers, I'm going to have balance, small body candles or no body candles like dojis. If I have an imbalance in order flow, I'm going to have candles that are primarily body, where price action is moving in direction. More buyers and sellers, price will go up. More sellers and buyers, price will go down. What if I have candles that have one wick? Well, these can represent a lot of different things depending on the structure. If I look at this green candle here, we can see that price opened. At some point, it dropped down, and then it seems to have rallied the rest of the day upwards towards the close. Or I can have like the red candle to the right of it, where price opened at the top, dropped down, and then pulled back before the end of the day, before the close. And then, of course, there are the 2 wicks, more traditional open, close, high and low candlestick structure. To understand periods of equilibrium in the market, you do need to understand what a balanced candle is. So a balanced candle is a candle where the body of the candle is 50% or less the range from wick to wick. In other words, if I measured from the top of the wick to the bottom of the wick, is my body 50% or less that entire range? Now, these will often represent periods of equilibrium in the market, and we're looking for these areas to see when there is equilibrium in the market, because we want to see immounts leading out of equilibrium when we're looking for institutional order flow. We will talk about this more in later lessons, more in depth, but these represent periods of balance in the market. Now, one thing to understand about balance candles is that not all balanced candles will necessarily be in areas of equilibrium, because I could have a big impulsive candle that just has a very long wick, but it could be more directional in movement. So even though not all balanced candles will be in periods of equilibrium, when we are looking for periods of equilibrium, we want to see balanced candles in that area. Finally, here are some candlestick formations that you can study. These are just some basic formations that everyone should know. I don't want people to overvalue candlestick formations. Is it useful to understand this stuff? Yes, but you should never be making your trading decisions purely off of candlestick formations, because as a standalone form of analysis, they are not consistent. So these are the types of things that we can use as enhancement to understand potentially directional movement, but only in confluence with looking at things like institutional order flow and fundamental and technical analysis. Never as a standalone form of analysis, because on their own, they're very inconsistent. By no means does every hammer lead to a bullish movement. Same thing when we're looking at bearish formations. You should not consider these, oh, if I see a hanging man, that means it's going to go down. No, sometimes it will, sometimes it won't. It's not a standalone form of analysis. It's something you're using in confluence with institutional order flow analysis and all these other factors we look at, like fundamentals and technicals. That is it for this lesson. Quick lesson today. In lesson 7, we're going to talk about trend and control points and multiple time frame correlation. And that is it. Thank you so much. This is Mr. Black signing off.